Hey everyone, so in this video we'll talk about accumulation and distribution, how the method has kind of evolved over the years. It started with Wyckoff and then Stan Weinstein kind of improvised it, and how my method has a bit of advantage on the Stan Weinstein's method that is already there, right? So we'll get started. We'll try to understand first the Wyckoff's method, then the Stan Weinstein's method, and how my method of using the data with the charts kind of helps you have that additional 20-25% kind of extra edge over the Stan Weinstein's method, right? So let's first start with Wyckoff's method. So Wyckoff, so this price chart or price cycle you guys would have already seen, right? So it is there in the internet as well. So first you have the accumulation area, where from an oversold area it kind of starts, big guys start to accumulate it. Then we go into a markup phase wherein the prices kind of move up rapidly, and then we go into a distribution area wherein the big guys kind of sell it out to the small retail investors, and then followed by a markdown phase wherein stocks kind of come down. So we are going to see different examples. Also, I've taken three different examples: CDSL, TCS, and even alkyl amines, to kind of understand how the whole thing played out there, so that you would know how to make use of these accumulation and distribution cycles to kind of identify and sell when the distribution is happening, or buy when the accumulation is happening, right? So this is like a very basic thing, just to give you an idea as to how the cycle plays out. Now we'll go a little bit deeper into Wyckoff thing. So in accumulation phase, he has phases, five phases, from phase A, B, C, D, and E. So in phase A, what he says is, so the selling kind of comes to a halt, right? An exhaustion of the selling happens, where you see the SC written, right, in phase A, and then you have a rally that comes in, because from an oversold area we have a rally, and then again it kind of falls from that area. So basically in this area it is kind of making a little higher high, and then in phase B what happens, the big guys they start coming in. So in phase B is where the accumulation actually starts from the big institutions. So what he says is, how can we identify this accumulation in phase B from the big institutions, or let's say the operators, is, he says, with very high volume the stock usually does not move, wherein you are seeing huge volumes but the stock is not moving at all. It is at that particular place, or moving very little, hardly 1% or 2%. So that is how he says accumulation is happening with a very limited kind of an price movement. So these guys, they did not let the price move. What they'll do is, they'll buy, and then as the stock moves a little higher, they themselves will kind of control it, bring it lower, and again buy and push it a little higher, again kind of sell it to make sure that, okay, the stock comes back, the price comes back, again keep buying it from the retail. So this is what happens in phase B. High volumes, no real improvement in the price, and that is how Wyckoffs usually mention that this is how the accumulation happens in phase B. Now phase C is very important. This is more like a litmus test for the operators and the big guys. What they do is, they intentionally kind of go make the price go below the previous low that it had hit. So this is going to create panic among the retailers, and they'll be like, okay, this is again going lower, I should be booking out, right? So when, because a lot of retail investors have this stop loss in place, right? So we kind of draw these horizontal lines and have stop loss. So without the help of data, when you play that, you kind of don't understand what is happening. Either accumulation is happening or distribution is happening, because just from the chart it will look like intent, it is kind of breaking down and it is time to sell. So when those panic retailers kind of get out, that is when these guys would know that, okay, the bottom is almost done, and they do a test, that is they kind of push it back up and then let it be. Let's see what retailers are doing. In case it does not break the low that it kind of did in phase C for the first time, they know that most of the retailers are out of this stock and it is time for them to start pushing it higher, right? So in phase D, they start finally pushing it up, they break that trading range, right? So they usually break it and then do a retest. So why this retest is important is, so once the breakout is done, If there are still few more weak hands who feel that okay, it is time better to, if I get out of this stock and then again re-enter, so those kind of people usually they start selling a little. That causes a bit of price fall, right? And once that price fall comes to a halt, right, it holds that breakout level. These guys know that okay, most of the retailers are out, whoever kind of bought in from the lows, right, those guys are also out. And then phase E starts, which usually is the markup phase, wherein the stock continuously starts moving up, making a higher high, higher low. So this is what happens in the accumulation phase as per Wyckoff. So now coming to the distribution phase as per Wyckoff. So what he says is the same thing. In phase A, the buying exhaustion kind of happens first, and then you fall because of the overbought territory, you kind of fall, and after that it kind of moves up a bit, right? And that is when the big guys also kind of start to realize that okay, now it has come up, the valuations are also kind of stretched, makes sense for us to also start booking out. So phase B is when the major distribution kind of starts to play out. So in phase B, what they do is with they kind of give you a false breakout also, where UT is written in phase B. You know that there is a false breakout, which a lot of retail investors who are kind of just trading breakouts, right, they kind of enter there. So even that kind of fails because they kind of make use of this to sell out. So when this is happening again, he says that high volumes with no real improvement in price, that is when you know that okay, now distribution is happening in that stock. Then the final one, phase C, whatever little is left with the big guys and the operators, they kind of give it one final push, right, in phase C, where it again breaks the high, but that breakout also fails. So once phase C breakout fails, right, people who kind of get trapped, they don't want to exit the stock because fundamentals are looking good, the recent results are really great, they don't want to and exit that particular stock, so they kind of get caught at the top, right? And then phase D starts, where it starts moving down, it kind of breaks all the supports, right, does a small retest of the breakdown, and many people kind of start re-entering, right? But by now most of the operators and the big guys would have already sold whatever they have. And finally phase E starts, wherein you have a markdown phase, and then the stock continuously starts moving lower. So this is how Wyckoff kind of explained how the accumulation and distribution kind of plays out. And the markup and markdown phases are quite easy. You must keep making higher high, higher low, and in the markdown phase you start making lower high, lower low, and keep going down, right? So this is about Wyckoff, but then people found it really difficult to kind of understand whether in a reaccumulation phase is happening or a distribution phase is happening. So to kind of get over that, what Stan Weinstein did was, so we'll go to Stan Weinstein's stage-wise analysis now. He kind of improvised over the Wyckoff thing. So in stage one, so he, instead of giving it accumulation, markup, distribution, and markdown phase, he kind of explained it with stage one, stage two, stage three, and stage four. So basically, stage one is accumulation phase, stage two is your markup phase, stage three is distribution phase, and stage four is markdown phase, right? So this cycle keeps on happening. So the improvisation he did was he added 30-week moving average to that line, so that you know that when reaccumulation is happening and when the final distribution is actually happening. So what he says is, in stage one, when accumulation is happening, the stock price will keep moving along that 30 WMA line, going up and down, up and down, and finally once a range breakout happens, very similar to Wyckoff, once a range breakout happens, we know that we are in stage 2. I'll show it in an example also. So once stage 2 starts, it will not breach the 30 WMA line. It might come very close to that 30 WMA line sometimes, take support from there and move higher. Then comes stage 3, wherein the stock does a up and down movement on the 30 WMA line, and then finally once it is broken, stage 4 starts and it starts to fall, right? So this is something that a lot of people use, right? But the method that I use kind of has an edge over this as well. But Stan Weinstein, he improvised two things. One is he introduced the 30 WMA line on this, and also he used another indicator called as relative strength, which Wyckoff was not using. So relative strength is a concept wherein you kind of compare two different stocks, or let's say a stock with an index, to kind of understand whether the particular stock that you want to buy or trade is having a higher relative strength. That means it is moving much higher than what the index is moving. For example, I can compare CDSL, or let's say CDSL, with the Nifty chart or the mid cap index, right? To understand, is CDSL doing better than the mid cap index? If it is, what generally happens is, so there are a lot of relative strength indicators on trading view, right? You can choose any of them. There you just have to change which one you are comparing it with, right? So usually, since it is most of them are made in the US, right? So there they would be comparing that with the S&P 500 or the Dow Jones. You would want to compare it with the Nifty or the mid cap or the small cap index. If it is a sectoral, like something like Lupin is there, which is a pharma stock, you can compare that with the pharma index as well, right? So once, what he says is, when there is a range breakout, there should be a relative strength should be higher than zero. That means the relative strength of this particular stock is outperforming the index that we are comparing it with. So that is the area he would say is the best time to kind of enter these stocks. So then the conclusion is, on Wyckoff's method, Stan Weinstein introduced two additional things. One was the 30 WMA and one was relative strength. Making use of these two, he was able to kind of make better gains over on making use of this stage-wise analysis, right? So till now we have studied Wyckoff's method. Then we have studied how Stan Weinstein improvised on this. We'll look at a few examples, and then we'll look at how my method will kind of give a little advantage over this particular thing, right? So just looking at the charts, sometimes you might get confused, right? So that is the reason, if you kind of have the data to give you a double confirmation. So let's say you feel that, okay, accumulation is happening. If the data also suggests accumulation is happening, then you have a double confirmation and you can enter it even before the range breakout happens, because you know that the big guys have started buying it. Same way during distribution, if the data is also saying that distribution is happening, you can kind of understand that, okay, distribution is also happening now. Even as the charts are showing distribution plus the data is showing it, you can exit it even before the range breakdown happens, right? So this is a improvement over this method, and how we'll see how much kind of percentage you can make, improvise making use of the accumulation distribution method that I kind of follow. So few of these examples, CDSL, you can clearly see how stage 1 accumulation happened, and then it went up in stage 2, and then stage 3 it went sideways, right? And then finally breached the 30 WMA line, and a small stage 4 happened, right? From a level of 1500 we almost fell to 900 800 levels before again going into stage 1. Now currently the stock is in stage 2, right? Although I have not mentioned it there, the stock is currently in stage 2 as of now, but it is coming very close to that stage, 30 WMA line. Chances are it can, this itself can be stage 3, but only time will tell that, right? Now looking at one more example, that is TCS. You can clearly see stage 1 and then stage 2, it went up, stage 3, stage 4. Usually good quality stocks will not fall much in stage 4 compared to cyclicals will have a big drop down, right, in stage 4, and then stage 1 has followed in TCS. Now coming to the final example, wherein I have kind of highlighted the levels where we could clearly see accumulation as well as the distribution happening. So in alkyl amines, the breakout actually happened around 353, but the bottom in that stage 1 was somewhere around 222. So let's say if the accumulation was happening, you would have bought it somewhere in between, probably 250, 260. That itself would have given you a 20-30% kind of advantage even before the stock actually broke out into stage 2. So probably let's say 20% you made here by buying it along with the big guys in stage 1. Then comes stage 2 wherein clearly it is moving higher. Here also when the reaccumulation phase is happening, you can add up as well instead of blindly adding it at any point like many people do this, that is pyramiding, right? So many people have this pyramiding, they kind of average it at any price they want. Instead of doing that, what you can do is you can buy it when the big guys are also buying. So how we kind of come to know, with the help of the data you will understand that okay, even the big guys are buying it at these levels. So if the big guys are buying it at these levels, there is very little scope for the stock to fall from that particular level, right? So you can pyramid at that particular point, right? So now it went to stage 2, and then in stage 3 I have highlighted there, you can see clearly that 4706 was the top that it kind of touched, and then it finally breached the 30 WMA around 3708. So even let's say you were able to sell the stock around 4500, right, making use of the data that I used, right, wherein it clearly showed some kind of a distribution or pretty good distribution happening there. So with the help of that data, let's say I sold it at 4500 instead of selling it once it broke the 30 WM around 3700. Again I would have made around 20% on the top as well, right? So this is how combining the data with this method will kind of help you make that additional 20% which you would have not made if you were just following the Stan Weinstein's method, right? So this accumulation distribution you can kind of use with the help of data, right? You can use it for short-term trades and even for your medium to long-term trades as well, right? So this is how the whole accumulation distribution concept has evolved over the years. So Wyckoff did it, then Stan Weinstein, and now I have kind of improvised it over the Stan Weinstein's method with the help of the data, right? So this is what I have been even teaching many retail investors also. So in case if you are investor interested in learning this particular thing, you can definitely contact me on Twitter. My handle I have mentioned it in the comments also, or in the description. You can ping me, right? Hopefully this helps to understand how the whole cycle plays out, and you should be able to identify which stage your stock is in to kind of take a better decision, right? Hopefully this helps. Thank you.